Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTWSYS008 traders. The title of this video is how to catch the third Elliott wave, alright? There are many ways we can catch the third Elliott wave, which is usually, in theory, the longest wave, all right? Many ways, all right? There is one specific way that we can use, catch the third Elliott wave using a moving average crossover. But in this video, I will not talk about that. I keep that one for myself, all right? So that's the only secret that I have when it comes to Elliott wave trading, all right? But in this video, I want to show you, okay, a few tips and tricks that you can use to catch the third Elliott wave. When we are talking about the third Elliott wave, we want to apply what? The wave principle. One thing that I always say to traders, all right, we don't want to violate the market principles. We don't want to violate the market stable data. We don't want to violate the market patterns. Now, when we are trading the price. We can be using the stochastic, the RSI, the MACD, the moving averages. But, ladies and gentlemen, when we are applying, okay, we are trading the Elliott wave, we must focus on the price itself because the wave principle allows us, okay, to identify 13 specific price structures, all right? So how do we catch the third Elliott wave? We want to apply the wave principle. So what the wave principle is telling us, the wave theory is telling us. The wave theory is telling us. So before the third Elliott wave, what do we have? We have the first wave and the second wave. So we must see first the first wave and the second wave. That's the first condition. So if you are not able to identify the first wave and the second wave, you are likely to get into trouble, all right? Now, we know that the first wave is an impulsive wave, and the second wave is a corrective wave. The next thing that we need to try to understand is the structure of the second wave. Okay? So you want to check the corrective waves, the Elliott wave corrective wave. This is the key. All right? Okay? So we see the first wave, the second wave. We want to catch the third Elliott wave. Now, you say to me, George, I know that already. Great. All right. The guideline that we teach traders at www.24elliottwave.com is this. You watch it, okay? Always, very often, in a normal market condition, we will see that we see a consolidation, okay? Consolidation can be a market open, especially for forex traders, market open, and you see a consolidation was taking place. And then we have a breakout. The breakout should not take place around a key resistance zone. Otherwise, it can be a fake breakout. And then the price will pull back. Usually, try to retest the top of the consolidation. And then we have the third Elliott wave. That's beautiful, but it doesn't happen always like this. It can be messy, can be hidden, can be complicated, can be complex. All right, but using the wave principle, all right, what the wave principle is telling us? The wave principle is telling us that the second wave must not cancel the first wave. So here we are. So if I call this the first wave, the second wave must not go beyond the beginning of the first wave. Shouldn't go back below it. That's the theory. Sometimes things can be messy. Market can be distorted. So based on that principle, that the second wave must not cancel the first wave, all right? Professional traders, okay, professional investors usually will place their trade, will place orders to buy, okay, automatic orders to buy at 61.8%, even at 78.6% of the first wave. So once they see the first wave, don't get too excited, all right? I'm going to tell more about this. So they see the first wave draw Fibonacci drawing tool. They will highlight the 61.8%. And they will also highlight the 78% Fibonacci retracement level of the first wave. All right. So once they've done that, why are they doing that? Okay. This is not about technical trading alone. They have done already what we call, okay, the Google Acid test. They have done their due diligence. So they know that these companies having more market share, okay, they are dominating their sectors, they have excellent management in place, the market environment is bullish for this stock, okay, the global economy is viable, it's not a bearish season, and they know that everything has aligned for this stock to go up. So they have done the fundamentals. You remember what I said to you before? For a stock to go up, it must have a shear, all right? Either you are driving an electric car, okay, or you are driving, okay, the petrol car, all right? So you must have enough fuel. The fuel is the fundamental, okay? You want to check whether they are making money. If they are making money, are they at the end of their cycle, okay, all right? Are they starting to make money? Do they have a future? All right. So they're fundamental. So after they have done their fundamental verification, and they know that, okay, the only way for this stock is up and everybody will be happy to buy it. The price is at the right price. It's the right price. Okay. The fundamentals are solid. The market environment, talking about the trading triangle, they done their verification. If they see the first wave and the second wave, all they do, they place the order to buy at 61.8% or 78.6%, and they will place their stop loss below the beginning of the first wave, because the first Elliott wave stated that the second wave must not cancel the first wave. If the fundamentals are solid and the market sentiment is bullish, the market environment is also viable, okay? Remember, all right, the environment is very, very important. All right, you want to dry something, you want to have a sunshine, a wind at least. The environment is very important. Market sentiment bullish, market environment viable, okay, fundamentals solid. We can apply this strategy to catch the third Elliott wave. It makes sense? It is also powerful. So the first thing that an Elliott wave, an intelligent Elliott wave trader, okay, somebody who does not want to gamble, somebody who is willing to make excellent decisions, somebody who wants to buy and hold, okay, a stock, will go to Google Finance, okay, or Yahoo Finance. If he or she is trading Forex, we'll go to Forex Factory, check the fundamental, or read some article of Bloomberg, or watch some fundamental videos on YouTube, or subscribe to the Financial Times, or something like that. He or she, after performing the due diligence, have seen the first wave and the second wave, and he or she is happy, will place a trade, a limit orders, okay, automatic orders to buy at 61.8% or 78% Fibonacci retracement level, hiding their stop loss just below, okay, 20 pip or 10 pip below the beginning of the first wave. Why the second wave will not go beyond the first wave? It will not go beyond the starting of the first wave if the fundamental is very, very strong, if the market sentiment is very, very bullish. People are waiting to buy, okay? What is usually taking place? Some traders will place, investors will place their trade at 50%, orders to buy. Some will place their trade, orders to buy at 61.8%. Some will place their orders to buy at 78.6%. Some will place their orders to buy at 88.6% Fibonacci retracement zone, providing a support for the price. As the price is trying to go down a little bit for one reason or another, these orders are filled. Stop preventing the price to go beyond the beginning of the first wave. Very simple and very powerful. This is how some professional traders are catching the first Elliott, the third Elliott wave, which is in theory the longest wave. What I have done today, I have explained to you the wave principle, that the second wave must not cancel the first wave, provided that the fundamentals are solid and the market sentiment is bullish and the market environment is viable. The three conditions must be in place. The three conditions must be in place before one can apply the wave principle like that. Ladies and gentlemen, if, all right, the fundamentals are weak, all right, The market environment, for instance, is bullish, but the market environment is not viable. The second wave may cancel the first wave. What the wave principle is saying to us is that in normal market condition, in a viable market condition, in a bullish market condition, in a bullish environment, it is impossible for the second wave to cancel the first wave. Now, if we interpret, okay, the wave principle in another way, we can say clearly that, but the second wave can cancel the first wave if the fundamentals are weak, if the market environment is poor, okay, if the market sentiment is bearish. We can say that, yes or no? We can say it. So this is how we can catch the third Elliott wave using the fundamentals and a Fibonacci retracement level with limit market orders, okay, to buy. It makes sense? It's also powerful. This is one example of how one can catch the third Elliott wave in an up move. The opposite is also true when we are in a downtrend. In a downtrend, it probably go down. So the scenario, our guidelines, which I always follow myself. You see me all the time, I'm counting wave. That's what I follow. It's not magic. It's very simple. Trader call me all the time and say, Joe, can you give us, a personal training? There's no personal training. www.24ElliottWave, www.youtube.com/user/24ElliottWave. Our website, our YouTube channel, 24ElliottWave YouTube channels, all right? Our Google Plus web page, 24ElliottWave again. All I'm doing on our Facebook page, all we are doing is to share, okay, our knowledge with traders for free, all right? Because the wave principle is a free, okay, material on the market, and I do not sell anything that contains the wave principle, all right? It makes sense? So if the opposite is also true, if the price is in a downside price, we see a consolidation and then a breakdown. The breakdown will be a forced breakout down if we are at a valid support zone. I explained this in another video. I don't want this video to be too long. I want to focus on what I'm talking about here, how one can catch the third Elliott wave without deviating from the key subject. So price pullback, all right? Again, if in a downtrend, what are we looking for? So we see the first wave, the second wave. Now, if the market sentiment is bearish, the market environment is poor, which means it's not bullish, all right? The global market sentiment, the global market environment is not bullish or it's poor also, all right? And the fundamentals are weak, the three conditions for a bearish progression, all right? The second bearish Elliott wave will not cancel the first bearish Elliott wave. We can also interpret the same wave principle in another way by saying that if we have a bearish first wave, but suddenly, okay, the market environment has changed and is improving, the market sentiment has changed from bearish to bullish, becoming bullish, and the fundamental starts improving, there is a high chance that the second bearish wave will cancel the first bearish wave. So the problem that traders are facing when they are using the Elliott wave is that they try to use it as a science. It would be beautiful if it was a science. We can all use some automatic software and do our own thing without checking Google for now, without checking Yahoo for now, without checking economy news, without doing any work at all. It's not like that. Especially if you are a new trader, the tendency is to use the technical alone. I've done it myself, but go ahead quickly, okay? Move away from that stage quickly when you are ready, okay? All right? I know how it is for new traders when they start trading first, because you just want to use your technical and go back. The market movers, okay, the big market players, the bank, the hedge fund, the big institutions that are moving the market up and down do not trade the technical alone. They combine the technical trading, the wave principle, and the fundamentals. All right, it makes sense? It is also powerful. Again, here, if you are in a downtrend, professional or smart investor will place orders to sell at 61.8%. Some will place a trade to orders to sell at 78.6%, and they will place their stop loss below the beginning of the first bearish Elliott wave. If the market environment is bearish, the market sentiment is bearish, the fundamentals are going down, they are losing market share. The management, like we see for Nokia, it was a time they just fell under the competition. The management in place couldn't catch up with the innovation, and they were not making money. And we see for Nokia what has happened to Nokia. All right, Microsoft was nearing the same situation, but they quickly adjust, which I like. I told you that Microsoft is a bullish cow, and they recover quickly. If they did lose their market share, they will go through the same scenario. So fundamental first, bearish fundamentals, bearish market sentiment, bearish market environment. The second bearish wave will not cancel the first bearish wave. We can place orders to sell at 61.8%, placing our stop loss behind the beginning of the first bearish Elliott wave. If, depending on your risk tolerance, the price sometimes will not go to the 61.8. The price can change direction, which means some trader will place order at 38.2%, 50%, 61.8%. But this, because the small money like to sell or buy at the best place, very often, what we need to understand, talking about the wave principle and the Fibonacci trading, the second Elliott wave tend to go very often, okay? Very often. You see that the second wave will try to return the 61.8% zone very, very often. So if you are trading the Fibonacci and you like the 61.8% or the 78.6%, it's usually true during the second Elliott wave. But again, what I'm doing here, I'm just going a little bit, giving you the key information, but there are more to this because we have to analyze the structure of the second wave itself, bringing us to the corrective waves, the formation of the corrective wave, the structure of the corrective waves. It makes sense? All right? It makes sense? It is also powerful. All right? So this is how one can catch. There is one thing I need to mention here, that there is no third Elliott wave, a true third Elliott wave, without a strong fundamental in an up move. Okay, there is no third Elliott wave or strong third Elliott wave in a downtrend if the fundamentals are not poor. All right, if the company is making money, people keep buying because their true value is increasing. The smart money want to buy. So if their true value is 100, the smart money very often would like to buy 5 times the true value maximum. All right. So they're creating value, they are making money. They are gaining more market share, excellent product, excellent management in place, future looking bright, market environment bullish. Their true value will be increasing. The same thing is true if the company is losing market share, their strategy is failing each time, all right? They couldn't adapt to the current market environment. No innovation is taking place, their true value is going down. It's pointless, to buy them at any price level because it continues to go down as the smart money realize that they are not making any money and probably they have failed the Google Finance Assist tests. Ladies and gentlemen, this is the end of this video. As I explained to you at the beginning of this video, there are many ways we can catch the third Elliott wave. And in this video, we talk about the Fibonacci retracement, the fundamentals at Google Finance, Yahoo Finance, the Forex factoring, all right? And the wave principle itself, the second wave will not cancel the first wave if it is supported by the fundamentals. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS008 traders. In the next video, we will be talking about how to catch the fifth Elliott wave, and I will be explaining more tips and tricks to you about the wave trading. We are the TSTW SYS008 traders. Until the next time, enjoy yourself and be very happy. Speak to you soon.